For executives holding incentive stock options, ISOs, one of the most searched financial warnings is the ISO AMT trap. It is a structural flaw in the tax code that can force you to pay massive taxes on phantom wealth you haven't actually cashed out yet. When you exercise an ISO, you do not owe regular income tax on the spread, the difference between your discounted strike price and the current market value. However, that paper profit is treated as income under the alternative minimum tax AMT system. If you exercise a large block of options and hold the stock to qualify for lower long-term capital gains rates, the IRS tracks that paper profit. If the stock price collapses before you can legally sell your shares, your tax bill doesn't drop with it. You still owe real cash based on the peak value from the day you exercised. The math. You hold 10,000 vested ISOs with a strike price of $5. The stock is currently trading at $55. You execute a buy and hold strategy to trigger long-term capital gains. The paper value. Your total strike cost is $50,000 to acquire $550,000 worth of stock. Your paper profit, the spread, is $500,000. The AMT bill. The IRS treats that $500,000 spread as AMT income. Assuming an effective AMT rate of 28%, you face a $140,000 tax bill due the following April, even though you haven't sold a single share. The trap. Before your one-year holding period ends, the market corrects and the stock drops from $55 to $15. Your shares are now only worth $150,000, yet you still legally owe the IRS the $140,000 in AMT based on the original peak value. Without strategic planning, you are forced to liquidate almost your entire remaining portfolio just to pay taxes on wealth that evaporated. Managing this requires calculating your personal AMT runway to exercise the exact number of shares each year that keep you just under the tax threshold. To map your ISO exercises against your personal AMT threshold, contact Lone Wolf Wealth Management to schedule an equity optimization review. Regulatory disclosures. Lone Wolf Wealth Management is a registered investment advisor. This content is for educational and informational purposes only and does not constitute personalized investment, legal, or tax advice. Firm CRD 340537. Day 3. Search query. When to sell company stock after RSU vest? When is the best time to sell my company stock after my RSUs vest? This query dominates search trends for a reason. Many professionals hold onto their shares out of loyalty or a belief in future growth, unaware that holding is mathematically identical to buying the stock with cash. To understand the architecture of an RSU, you must realize that a vest date is functionally a cash bonus paid in shares. If your company gave you a $50,000 cash bonus today, would you immediately open your brokerage account and put all $50,000 into a single stock? If the answer is no, then holding onto your RSU shares after they vest is making that exact investment choice. Since you are already taxed on the full value the moment they vest, executing a same-day sale triggers zero additional capital gains tax. It frees up your capital to be redeployed into a diversified, structurally sound portfolio. The math. An executive receives a vesting block of stock worth $100,000. After a 35% automatic sell to cover for taxes, they are left with $65,000 worth of company shares. Scenario A, the hold strategy. They hold the shares because they anticipate a strong product launch. Over the next year, a sector downturn hits and the stock drops 30%. Their remaining equity shrinks to $45,500. They now carry a concentrated loss alongside their career risk. Scenario B, the sell strategy. They execute an immediate same-day sale of the remaining $65,000. Because the sale price matches the vest price, they pay $0 in capital gains. They immediately reallocate that cash into a diversified portfolio or advanced tax shelters to offset their active W-2 income. Even if the market drops 10%, their wealth sits securely at $58,500. By holding the stock, you link both your regular salary and your personal net worth to the fate of a single company. A same-day sale breaks this concentration risk without adding a single dollar to your tax liability. To construct a programmatic liquidation strategy for your corporate equity, contact Lone Wolf Wealth Management to schedule a portfolio diversification review. Regulatory disclosures. Lone Wolf Wealth Management is a registered investment advisor. This content is for educational and informational purposes only and does not constitute personalized investment, legal, or tax advice. Firm CRD 340537.